Ali Mogharabi from Morningstar and Trip Miller from Gullane Capital Partners for their reaction. Ali, I'll start with you. Why is it trading low?
Well, probably a miss on the bottom line. I think that's about it. That's the only thing that I can see. What I would say is the revenue was very strong. I mean, you're talking about a 20% growth, which many actually doubted after Q1. Looks like their advertising remains strong, and the other bets. So I think they're having they're pretty successfully actually monetizing YouTube further and capitalizing on that mobile search. I think it looked pretty good from the top line.
Trip, your take?
It's very similar. We think that they did excellent on the top line. It's a bottom line story. It looks like it was heavily affected by the change in Uber on the valuation there. But we're pretty pleased with what I've seen so far from a segment standpoint. We think there's a lot of opportunity in health, and I think that's something that's been underreported is how much they've bulked up on the leadership side of their health business. That's coming into view a little bit today with their stories on Fitbit. But at the end of the day, you know, it's a rounding error when you look at $120 billion in cash and $20+ billion in free cash flow. So we'd like to see them do more with that cash, potentially ramp up the buybacks, $25 billion authorization last quarter. So we think there's a lot of opportunity to return value to shareholders. And hopefully tomorrow, if the stock's down, they'll go in and buy back some more stock pretty aggressively.
Trip, what about using some of that cash to make some plays in the cloud space? Is that something that you want to see the company do?
We do. I mean, we'd love to see them grow that. We think there's a tremendous opportunity among all the players in that space. You obviously saw last week both Microsoft and Amazon slow down a little bit in their growth rates, but you know, versus the rest of the businesses that they have, this is a segment that's still growing, you know, fairly rapidly, and we see a big opportunity not only over the years but over the next decade there. We think strategically they could deploy their capital a lot more wisely than just sitting in cash, but you know, cash is oftentimes a very nice thing to have, and we believe long term that they'll do the right things with that cash.
Ali, how are they doing in cloud compared to Amazon and Microsoft?
Well, compared to them, of course, they're still the number 3 player. But in terms of market share gains, in terms of taking market share away from the two other players, we still think they have a long way to go. But as your other guest mentioned, I think it's a very attractive market. We actually have them growing at a 45% CAGR the next few years. So we think they'll actually make some traction on that end. In terms of acquisitions, on the cloud front, we're actually waiting to see these guys continue to invest to enhance their sales force on the cloud business. I think that's the most important thing. They brought Tom over, and they're bringing on additional former enterprise software executives and salespeople. So I think in our opinion, that's the best way to strengthen their cloud side of the business. And then after that, hopefully, you know, a few years down the road, hopefully again allocate a little bit more capital towards acquisition of some cloud businesses.
Trip, there's been a little bit of a theme running through the research and commentary on Alphabet that it should be viewed on kind of a sum of the parts basis, whether you want to take YouTube, some of the other bets, cloud, add it all together, put it a kind of a market peer multiple on it, and all of a sudden you have a higher stock price. Is that valid at all with really no clear line to an idea that Google might ever really split itself apart in that way?
I think it's one way to value the business, and it certainly helps to look at a business multiple ways when you're considering investing in it. Certainly on the sum of the parts, we think that a division like YouTube is heavily undervalued, and their other bets column that is burning through several $1 billion a year in cash. We think at some point could pay off big time for them. So when you think about the business that way, there's a lot of value in it. But we tend to look at the free cash flow coupon of the business. That's growing. It's very compelling. Although as value investors, we tend to not want to go and buy stocks at 52-week highs like we saw earlier today. So, for us, it's another way to look at the business. You're correct on a breakup value, but we tend to really focus on the free cash flow when thinking about a business like Google.